Recording in progress.
Good evening, everybody, and welcome to yet another session on the fixed income markets. Uh, for all of you, this is the final month of the year. It is compliments of the season as Christmas does dawn on us. For all of those of you who celebrate Christmas, Merry Christmas and Happy New Year. Today's session is quite interesting, given that the debt markets over the last year have been very exciting, and my guest for this evening will also attest to that. The words of volatility, pessimism, rate hikes, all of these that were absent for the better part of the last decade have now come back very aggressively in 2022. To understand this a little better and to get a viewpoint of the way forward, we've got our head of fixed income, R Sivakumar, with us. Siva, hi, good evening, and welcome to the show.
Good evening, everybody. And Shane just said, the objective today was just to look at sort of a recap in some sense of what's been going on in bond markets, with a view to seeing where things are how things are likely to pan out over the coming a few months, maybe a couple of years, and to also look at what is it's the end of the year, start of a new year. It's also therefore an opportunity to relook at our own personal lives, investments, where we are going, etc. So some thoughts about what we think investing should be looking like, etc. So there's a lot to unpack, but I want to stay somewhat focused. So I shall try to keep my opening remarks relatively short. So we'll just talk about some of the things that I see in bond markets, some of the global events and domestic events, and then we'll talk about also a new fund that we've got on, and that's really my agenda for the initial part of the session. Just to make it more interactive, etc. So what we will do obviously is focus the day on the Q&A. That hopefully will be more entertaining part of the conversation rather than just me talking.
Yes. So so to the audience, there is a chat bot on the right hand side of your screen. Please do write in your questions there, and I will spring them up to Siva when the Q&A session starts. Yeah, Siva, go ahead on the market outlook.
Great, thank you. So obviously, as I said, there are a lot of queries about what's going on with bond markets. And just yesterday, I was in a client event in a very different part of the country. I was in Guwahati last afternoon, and one question was posed to me that, is there a disconnect between what's happening in Indian markets and, let's say, the US, with the US Fed raising rates? What is the connection? Is there a disconnect? And it occurred to me that from a bond market perspective, it's not that we are just disconnected from the US. We seem to be disconnected from the RBI. 6 months ago, the RBI started raising rates in April. But let's say 6 months ago, back in June, the yield on 10-year Government of India securities peaked at about 7.6%. Today, it is under 7.3%, and despite the fact that the RBI has been raising rates very aggressively. Before we even get into the question of where we think rates are going to be headed in the coming months and years, we need to ask ourselves the question, what's been going on? What is it that the markets are seeing, and why is it so radically different from what the RBI seems to be doing? By the way, it's not just true about India. Even in the US, the Fed has been raising rates, and over the last several months, on balance, yields have dropped with a lot of volatility. It's not that these are either in India or in the US that there's been a secular decline in yields, but on the whole, bond markets seem to be relatively chilled about this very aggressive pace of hikes that we have seen. The RBI just recently raised rates by 35 basis points, but has been rising rates by 50 basis in the past. The Fed has just stepped down to 50 after hiking multiple 75s in a row. The ECB also hiked by 50 this week and has been warning of more rate hikes to come. Despite all that, bond markets are reasonably chilled. I think we need to peel back and see why that's the case. And I think fundamentally the reason is that markets are forward-looking. When you're making an investment decision by buying a 10-year Government of India security, what the repo rate is, and the RBI meets every 2 months. So effectively, the repo rate is a rate on very short-term overnight type of assets for the next 2 months. And the RBI will change its mind 2 months from now, and then 2 months thereafter. So beyond a point, the 10-year yield is not looking at where the next 2 months interest rates are. It's looking at what is the likely trajectory over the coming months and years, and more importantly, where this rate hike cycle will end. This is called terminal rate. That is a terminal point at which the rate hikes will stop. The Fed is quite transparent in giving forecasts about its own future path of interest rates. So the Fed has just been talking about the fact that they would like to take rates to about maybe a little over 5% by middle of next year. The RBI doesn't openly talk about these things, but it in a sense guides the market by commentary. And the market expectation from about May, June of this year is that the RBI will raise rates close to 7%. More recently, those rate hike expectations have been somewhat moderated, and the market now believes that we are very close to the end of the rate hike cycle, perhaps stopping at about 6.5%. Now, we are already at 6/4, which means the markets are essentially betting that the RBI will stop maybe with one more hike. And the reason for stability and, in fact, strong performance from long-term Government of India securities, as opposed to the RBI's raising of rates, is because of this change in expectations from the RBI. Even for the Fed, while the markets mostly believe that the Fed will hike as expected, markets now believe the Fed will stop probably just below 5, but somewhere close to the Fed's guidance. The market belief is that the Fed will soon start cutting thereafter as inflation comes down and as potentially a recession starts to bite in the US. So it's this expectation about the future that's really shaping how the market is behaving, which also means that rather than us looking at what the RBI is likely to do in February or come April, we need to look at what changes the terminal point of where the RBI will stop, or indeed, if at all in the future they cut rates. We need to start thinking along those lines. What are the triggers for rates to go up or rates to go down? Maybe with one more hike. So let's say if the RBI takes rates to 6.5 in February, will that rate then start going up, down, or stay sideways? So the expectations for the coming months and years have shifted away from what the RBI will do in the near term to what else can be triggers for the markets going forward. And as always, there are multiple things that can happen. And last year was, well, the year that's gone by has had all manners of shocks to the system. 2021, of course, we saw this massive rise in global commodity prices. Early this year, you saw the Russian invasion of Ukraine pushing those commodity prices higher. Oil, food, metals, everything shot up. Peak in inflation was the middle of the year, or peak in inflation expectations, and post that things have calmed down a bit. I think one of the important things that has really changed during the course of the last 12 months, and indeed I should go perhaps back to September, October of last year, is the fact that many global central banks, including the Fed, have finally figured out that there is an inflation problem and they need to start addressing it. And the way you address an inflation problem as a central bank is, well, to raise rates and remove liquidity. This is what they have all been doing. When you have huge amounts of excess liquidity and very low interest rates, it leads to all kinds of poor economic behavior. For example, when we have what's called negative real interest rates, that is to say interest rates which are below the rate of inflation, it leads to really suboptimal business behavior, or in general, investing behavior. If, for example, interest rates are at 3% when inflation is at 6%, which is approximately where we were a year ago, then it just makes sense to borrow and hold any kind of something, anything, inventory, You just any and every investment decision looks good. If I can borrow and park some assets, so park some cash in something yielding 6%, like for example, a block of steel, doesn't matter what, and the price of that asset rises 6%, then I can pay back the loan and make money for free. So very low interest rates, very easy liquidity encouraged all manners of behavior, which kind of entrenched inflation over the last year or so. But as interest rates have risen above the expected rate of inflation, these behaviors have started getting curtailed across the world. A year ago, the RBI repo rate was 3.35%. You go back a year and a half and close to 2 years ago, in fact, the entire money market curve was below 3.35%. 3.35% interest rates with 6% inflation. Today, the RBI forecasts inflation to drop perhaps to about 5.5% over the course of the next, let's say, 6 to 9 months. With 5.5% inflation and 6-quarter interest rates, many of those sort of malinvestment behaviors will get curtailed in India. The same is happening in the US, where interest rates are now gone to the 4+ mark, 4.5, and inflation expectations are dropping to 4% or below. Even the Europeans have joined in with taking rates up 50 basis points this week. So everybody is in this camp of trying to ensure that the interest rates are above expected rate of inflation. Once this bites inflation, once this changes in behavior, inflation will start to come down. We are seeing expectations of inflation coming down, and inflation should come down. Then the critical question is, what are those factors that can now cause inflation expectations to substantially change? What can change in terms of the new, what are the new things that we should be watchful for? And the risks are balanced on both sides. On the one hand, for inflation to drop, well, what happens if there's a US recession? What happens if there's a global recession of sorts? China has been a huge contributor to keeping inflation low, thanks to the fact that the zero COVID policies have ensured that they don't have any excess demand added to the system. To be sure, they also contributed to some spike in inflation because of so-called supply chain disruptions. And when you look at what we see now in terms of China reopening, in terms of expectations of cool down in the US economy, there is broad expectations that inflation will come down. The world also worked around the Russian invasion of Ukraine, food prices, metals prices, a lot of which these countries are large producers of, have also corrected as the world works around these the disruptions caused by geopolitical tensions. It's not that everything is coming up roses. There are risks out there. And one critical risk is the fact that domestic fiscal policy has been very, very loose for the last couple of years. To some extent, that's been to support the economy during COVID. And the government has been spending to ensure that the economy remains in growth phase. But that has also meant that the budgets have been disappointing and fiscal deficits have remained well above the FRBM trajectory for the last few years. Given that this is upcoming budget is the last one before an election, there's naturally some worries or fears that you could see a further expansionary budget. So of course, that's a risk we must keep in mind. But over time, we do see some kind of fiscal consolidation as the years go by. And the government has given a 3 to 5 year roadmap of bringing fiscal deficit back to the pre-COVID levels. So I think that's one thing that we need to be worried about. The second thing is, of course, a continued pressure from international factors. The geopolitical risks continue. There's every possibility that global rates, global inflation could remain sticky for a longer period than anticipated. So we should be watchful for those factors. But on balance, things are looking a lot better for us fixed income investors any time in the last 2 years. Year ago, 2 years ago, with money market rates at 3 point something, bond yields at 4 point something or even 5 point something compared to inflation, which remained stubbornly sticky at 5.5, 6 or more. We've now had 3 years average CPI inflation at 6%. The fact that finally yields have now risen to points where it is substantially above expected inflation is, I think, the first and most important takeaway of the last year. As I mentioned, despite the fact that short-term interest rates have gone up, longer duration has been very stable, somewhat volatile, but still reasonably stable in terms of it's a sideways move with some volatility. And this, I think, is what we expect to see more of. I mean, we don't expect to see much more of the rate hikes that we have seen from the RBI this year. We should start seeing the end of the rate hikes and the longer end of the yield curve likely to be still somewhat stable. So that's really it. I don't want to sort of go on and on about our views on bond markets. I think the objective was to sort of set the context, set the tone where we think that there is an opportunity across the curve. There's as Shane has very nicely put up this chart. I hope all of you can see that in general yields have risen to a point where substantial parts of the yield curve, whether you look at 1 year, 2 year, 3 year, 5 year, 10 year, the yields have now risen to a point where everything is compressed. Whether you buy a 3 year or a 10 year, the yield curve is substantially compressed to not more than 15-20 basis points. So you can actually get invested into relatively shorter duration Government of India securities or AAA corporate bonds without increasing your duration risk too much. But it is actually the duration part of the story that I want to spend the next few minutes on. But before we get into the longer duration strategy or story around how to invest for long term, I just want to introduce that we are doing a new fund. It's called the Access Long Duration Fund. But the duration aspect of it is the least interesting aspect of it. When we started thinking about doing this fund, our thought process was to find a product which investors could look at from a really long-term perspective, especially when you're looking at, as you get closer to retirement, as you start building up a kitty for the future, how do you look at your whole portfolio? And I think this kind of long-term savings is really something that we should look at. I am, as many of you, I'm sure, we were looking at world very, very differently when you're above the age of 40, as opposed to when you're in the 20s. When you're in the 40s, when you're getting into your 40s and 50s, the world looks very, very different from the world when you're 20s and 30s. For some of you, that might be that you pick up a new hobby or you develop a midlife crisis and buy a motorcycle or whatever it is that you like to do. This kind of manifests in multiple different ways. But on a more personal level, perhaps your hair starts graying or your hair starts going. You look at your old photographs from college and say, till last year, I looked like my college photo and now I don't. You look at your friends, they're also the same. Perhaps like me, you start wearing bifocals or maybe you get reading glasses. World looks very different, and you also start thinking about where you're going from here. For many people like me, I mean, I'm pushing very close to 50 now, is that the larger part of your earning life is now behind you, and there's a shorter part of earning life in front. There's a looming thing that in the next few years, I'll start retiring, or I'll think, if I have a kitty, I can retire early. I start thinking of how to plan for my kids. How do I start planning for, etc. And in our minds, or in my mind for sure, I put all of this into 3 buckets. One is a bucket that I'm keeping for my kid, make sure that he's educated, he's got a future. The same I would apply to all of you, I'm sure. The second bucket is for me and spouse, my wife. I'll say, okay, this is what I want to live on. And the third is splurge money, right? So this is what I'm going to keep. I'm going to spend it on travel, hobbies, and other stuff. And of course, if there is a lot left over, I'll leave that as a legacy. Here's a second one. How do I live on that I want to address? And that's really what this fund is trying to do. Now, many of us will know this concept of an annuity investing, where you look at investing maybe a lump sum and get an annuity back, perhaps after a period of time. And these are the kind of products which are quite popular when it comes to building long-term sort of post-retirement income. But a gap that I see is that the yield on these in terms of IRRs tend to be quite low, while the yield on just even Government of India securities, 30, 40-year Government of India securities are available at yields of give or take 740. These are not the kind of rates of return that you see on long duration annuities. So how can we, and while mutual funds, obviously you can't actually have annuities, there are no guarantees in this world, but can we not put together a product which kind of builds on this idea of creating an annuity for ourselves? So I started with this idea, and we also looked at another idea, which is a simple thought, which is that at 7% per annum, your money doubles in 10 years. And just walk with me through this. Let me walk this for about a minute. If I have a certain amount of money that I wish to save every year for the next 10 years, so to use a round number, let's say I'm going to save 10 lakh rupees every year for the next 10 years. At the 11th year, when the 11th year happens, at 7, assuming that the rate of return is 7%. So this is an assumption. This is not obviously a product. This is just an idea of how annuity investing works and how the mathematics, what are the mathematics behind annuity investing, right? Without it being a real annuity, just an illustration. So if I invest 10 lakh rupees for 10 years, in the 11th year, my first 10 lakh rupee has doubled in value. It's 20 lakhs now. Let's say I withdraw 10 out of that, only the interest component. So I leave the principal in, I only withdraw the interest component. 12th year, I withdraw the interest component on the second installment, which is another 10 lakh rupees, and so on and so forth. 21st year, I withdraw the interest on the 11th year. Remember, we left the principal behind. We only took the interest out. So that at 7% has doubled again, and so on and so forth. So potentially, whatever you put in, whether you do a monthly SIP or whether you do an annual installment or whatever it is that you do, whatever you put in for the first 10 years can easily be converted into an annuity. And since we have not touched the principal, so let's say at the end of 30 years, you're 50-year-old, by the time you're 80, you want a lump sum back, you still have the entire original invested amount plus the interest for the last 10 years. So potentially you're looking at, let's say, having invested 1 crore, you may have about 1.3 crores at the end of the period. This for me is a very powerful thing. It is a build your own annuity. Shane, next slide, please. You don't have to do 10 years of SIP. You do the 10 years of SIP, withdraw it for 20 years, withdraw it for 30 years, whatever you want to do. As long as you want, that works. You don't want to do there is one risk that what happens if the interest rates don't stay about 10 years about 7% for the next 10 years. You can hedge that risk by having a lump sum so that you lock in today's yields and then you start withdrawing after 10 years. If you have a longer horizon, you start when you are younger, you can withdraw more when you are older, or you can, instead of leaving a lump sum, you can have, let's say, a larger withdrawal. The advantage of mutual funds using as a combination of SIPs and SWPs is that you can completely customize these cash flows to the way you want it to. You want to step up in your annuity? It's not an annuity, of course. Please understand, there are no guarantees in this. But if you want to step it up, you can. If you want to step it down, you can. If you want to add some more money to it, you can. If you want to withdraw early, you can. There are no loads. There are no other lock-in periods, etc. And this is something I really like. And imagine that we can create this using a very, very long duration structure. And Government of India securities are available for 30 to 40 years. So which means whatever rates of yield are today, potentially that's the kind of yields we can lock up for 30, 40 years. And that's our investment horizon, really. This product is really suitable for someone who's in and around the age of 50, perhaps between the ages of 40 and 60, who's looking at the next 20, 30 years plus of building your own personalized annuity. I think and this is a critical need for all of us. To be sure, there are competitive products, which are these annuity products which are available in the marketplace. But there are some few important key differences that I must highlight. One is that we are at the end of the day exposed to the market. So whatever the market yields are, that's what you expect to lock in. Our intent is to hold as much of the securities to maturity as possible, which means while we intermediate mark-to-market risk, the mark-to-market risk, the duration drops as longer you hold. So that reduces the duration risk towards the over the decades. This mark-to-market risk doesn't, of course, exist in traditional annuity instruments. But what you do is you get a guaranteed rate. Mutual fund products, of course, don't have any loads, or at least in our case, there are no loads and no lock-ins, which means complete flexibility in terms of liquidity, creating your own portfolio. In terms of your own customization in terms of when you want to invest, when you want to withdraw. As I said, if you want to top up, you want to withdraw early, all of that is perfectly doable. This is an open-ended fund. There is no exact defined maturity. There is no such thing as premium paid and death benefits and all of these things that annuity instruments talk about. So plain simple, it's in your hands. Of course, you can leave it in the name of a nominee, but the idea is to build it, custom build it yourself. It is a reasonably tax efficient product. Obviously, it's not going to be the same as other annuity instruments, but that's something to keep in mind. I think taxation is one of the critical things that we need to take care of when we're investing in really long term. And the beauty of the Indian tax regime is that there is a 20% tax in long-term capital gains, but the tax is only on what's called real return, which is return over and above the rate of inflation. So sticking with our original assumption, if you make 7% per annum and the inflation is 5% per annum, for example, then effectively the government of India taxes you on the difference between 7 and 5. So for that 2% excess rate of return. So you pay 20% of that, which is approximately 40 basis points. Shane has done the hard work of calculating all of this for you. But just using a 5% indexation, which has been the average indexation for, let's say, the last 10 years, the return drops from 7 to 660. Of course, if the inflation is lower for the next 10 years, it'll increase your tax liability. Let's say if it's 4% per annum, then you pay tax on the additional 3% rate of return. All of this depends on what assumed rate of return is and inflation is. So there are no guarantees on all of this. But to give you an idea about what effective taxation. So if you pay 40 basis points as tax on a 7% yield, effectively your tax rate is a little over 6%, which is a very good tax rate if you look at it from a long-term saving instrument. And if you're really lucky, as in the last 3 years, probably you paid no tax at all. But that's not good because you've had very high inflation. So let's assume some moderate inflation over the next 10 years or 20 years. What is then the real story here? One is building a portfolio which is reasonably tax efficient, reasonable rates of return above inflation. And this chart really shows that long-term securities, 30-year securities, have historically traded in a range of about, let's say, on a broader basis, 6 to 9%, but narrower basis, 6.5 to 8.5%, or 6.5 to 8%. And we are about in the middle of that, close to 740. And that has been enough to beat long-term average inflation. There are pockets of time when it won't beat inflation, but long-term average rates of inflation, this seems to beat. So if we can create a product where we want to lock in ourselves, I mean, there's no lock-in the product, but lock in ourselves for 10, 20, 30 years at above inflation rates of return, I think this is a nice way to do it and build a little kitty for ourselves to live on. That's really it. I mean, if you ask me, there isn't much else. 2 risks I want to highlight before we close. One is that the assumption about long-term return in a product like this depends on the yield at which you invested. Today, the yield on 30-year, 40-year Government of India securities are close to 7.4%. If you intend to invest in this in an SIP type manner for the next 10 years or more, and you have in the back of your mind assumption that you want to earn 7% or more, then during that period of investments, the yield needs to stay above your target rate of return. There are ways to hedge this. If you have a lump sum upfront, you can put that up from upfront. So today's yields are locked in for that amount at least. So there are ways to mitigate this risk, but remember that the critical risk for long duration products is the yield at entry and whether that is reasonably good. There will be volatility in between because it's a long duration product. There's going to be significant volatility, but that does not affect us if our holding horizon is 10, 20, 30 years. Interest rate cycles in India last typically 3 to 5 years. If my horizon is 10 or 20 years, I'm going to see, 2, 3, 5, 10 interest rate cycles over my investment horizon. That's not very important, but it is there. There is going to be market volatility. But the last risk is also important, which is that this fund, because of its regulatory nature, which is a long duration fund, has to have a minimum 7 years duration at all points of time. So while we intend to reasonably roll it down and reduce our duration as we go closer to the 30, 40 year time frame, even 30 years from now, it will have a duration of greater than 7 years. So remember that when you look at it from a really long-term perspective, there is likely to be some residual duration risk in this fund. Whatever your horizon is, 10 years from now, 20 years from now, 30 years from now, there will be some amount of duration risk in it. But as I said, these things do get evened out over long periods of time. Interest rate cycles are short relative to the intended holding period that we have in a product like this. So it's something to keep in mind that there will be volatility. This is not a fund that you want to buy and then look at the NAV on a monthly basis. The idea is build your corpus and build your own, make your own annuity-like cash flow. This is using an SWP. That's really it. I think I like this idea. We've been working on this for a period of time now. And given the fact that as I alluded to at the beginning of this talk, in terms of our market view, things are looking a lot better today in terms of the market environment, in terms of how much rise in yields have already happened, and the fact that future rate increases have also been priced in. I think today is a very interesting time to be looking at this, and that's really where I will end. As Shane mentioned earlier, there is a box where you can ask your questions. I'm sure Shane has already got prepped and he's going to shout this out at me, and lay it on me, Shane.
Yep. So we've had quite a few questions, so I'll dig straight in. So for simplicity's sake, Siva, we'll start with a few questions on the fund itself. Just for everyone's benefit, the NFO is already open and it closes on the 21st of December. Siva, if you were to it's very evident that you've already started your retirement planning, and I'm sure you've already got your cherry picking done of what type of fund, what type of securities you want to buy. But if you were to be talking to an uninitiated investor, in our audience, we've got quite a few who understand some of the investment dynamics. But the basic philosophy is that the longer the duration, the more the risk. So how are we trying to structure that? And this is for everyone's benefit. How are we structuring this product to mitigate that duration risk? Is there something that we're doing?
No, that's a very good question, Shane, and thanks to whoever you asked it. I think it's a very important point. When you look at very long duration, and it's automatically our mind says that when you buy a short money market fund, it's less volatile than a short-term fund, which is less volatile than maybe a dynamic bond fund or a gilt fund. So in our mind we associate that, and it makes sense. But that only works in the short term, right? If you buy, for example, a 3-year security or a 10-year security and measure its price every month, it will appear volatile. If you buy a 3-year security and look at its duration after 3 years, it will have no volatility because the 3-year security will mature at the indicated yield. If you buy a 10-year security and hold for 10 years, there's no volatility. Yes, there'll be volatility along the way. So we have to look at two things. One is what is volatility and what is risk. Shane, your screen is still being shared.
Oops.
Understand what difference between volatility and risk. Volatility is just a market measure of how prices move up and down. Risk is a little bit more subtle. It's what is it that you wanted to achieve and what is it that you have achieved. So if your holding period is long enough, intermediate market volatility is not going to really affect you. If your holding period is long enough that, let's say, the security matures or you get closer and closer to maturity, the duration drops and the volatility consequently drops. If you buy a 3-year bond, initially it will be volatile, but after 2.5 years, it will have the residual maturity of 6 months and it will be as volatile as a money market instrument. Right? So this perspective also needs to be kept in mind, that risk and the volatility changes over the life of an instrument. The second thing to be kept in mind is, what is the underlying source of this risk or volatility? It is because of changes in economic conditions, interest rates, and so on and so forth. And those cycles, the business cycles and the economic cycles, typically run, in a period of, let's say, 3 to 5 years. The last couple of years have been a period of rising inflation. Couple of years before that, we actually saw some kind of a moderation. Let's say between 2015 to 2019, we had reasonably moderate inflation. In fact, inflation averaged in India for about 3 odd years at 4%. So these cycles of economy, cycles of inflation and interest rates causes some amount of volatility. But if your investment horizon is longer than that, if your horizon is 5 years, 10 years or more, then you ride across these cycles. So the way that you can mitigate risk is, especially in bond funds, is through time. And so while this fund will be very volatile from an NAV perspective, from a holding period risk, which is to say, if your horizon is 10 years or more, these things will get smoothed out over that time horizon. Portfolio will be long duration, right? Initially, we are going to be buying, let's say, if you look at the investment sort of pool of securities available, and you want to buy long duration, right, beyond, let's say, 30 years, 40 years, the only available securities are Government of India securities in that segment. So you're going to be buying very long duration Government of India securities. So it will be volatile, but it's going to be volatile today. It doesn't mean it's going to be volatile for the next 30 years, right?
Right. And how would you compare this with, say, a target maturity fund, right? I mean, target maturities are the name of the game. So
Yeah.
we are getting now to the level where you've got 10, 12, 15-year target maturity products that are coming into the system. So how will this portfolio work vis-a-vis that?
So most of the target maturity funds are, of course, much shorter than that. They are typically in the 3 to 5 year in segment. And I see a lot of money going into that because, it's very tempting to just buy and hold for that period of time. But one thing whenever I speak to investors who have invested either in target maturity funds or erstwhile FMPs, or in fact even FDs, and you ask them, what did you do with your money after that time was, or after that FD matured, or after the FMP matured, or after the target date happened? What did you do? And chances are they reinvested in another FD or in another target maturity fund or another FMP. It is very infrequently that that you come across someone who said, no, I specifically wanted something which matured exactly 3 years and 30 days, and I bought that fund. Because you don't know what you're going to do 3 years and 30 days from now.
Yeah.
So chances are our holding horizon is actually much longer than what you typically see in target maturity funds.
Yeah.
And especially when you're planning a retirement or post-retirement kind of a life, then our horizon is not measured in years, but it's probably measured in decades, 10, 20, 30 years. You are young, Shane. You're not my target audience for this.
Yeah.
As you get older and you spend more of the years that you worked is much more than the years ahead of you in terms of work, your perspective changes and you start really thinking in terms of, how do I replace my salary income or other monthly income with something which is a little bit similarly stable? So that it doesn't mean that this is a large part of your portfolio or something, but the idea is that you look at this as a kind of permanent long-term kitty. Correct. That's the only way to look at it.
Correct. Yeah. I also was very fascinated when you were working on this, Shiva, about how the math works. I mean, that was something really that blew my mind, and with whomever we've spoken to, at least at the product level, it just baffles with the number because of compounding, right? So typically we associate compounding with equity, and it's seldom that you see compounding with debt also gives you the desired results. So
yeah,
if you were to look at say someone who's just hitting his early 50s, what sort of structure would you recommend? Would you recommend more of an SIP based investing, or would you recommend pay as you go kind of lump sums? What works for you?
I mean, to be honest, we are talking. I mean, I know everybody is different here. Okay, so I don't have a point of view. I'll mention two things here. that one is like I said, everybody has different cash flow. Start working with what is it that you want to get out of it, right? So start thinking in terms of what is my current lifestyle, and therefore what is it that I need to spend every month. And if you work that back, roughly that's going to be your monthly SIP in for 10 years and give you the same annuity thereafter. So that mental math is that start thinking in terms of how much do I really want to get out of this, and that's really how much I need to put into it. Okay, that makes it very simple on one level. The second thing is, remember that this is not your only pot of money. Okay, while G6 are giving you 7.4% per annum today for 30-40 years, there's a very strong possibility that other assets will give you better rates of return. Right? You will get better rates of return probably on equities if you've got 30-40 year holding period. And people ask, why would I put money for 30 years into a G-Sec product? Why don't buy equity? And of course, I'll say, yes, you should. And going back to my original thought process, that you need to have 3 pots in your mind. One pot of money that you're saving is for certain known expenses for the future of your kids. Maybe you're saving for your house, or maybe you already paid for your house. Great. But if you haven't, you've got EMIs left to pay. So one pot of cash flow is always those committed cash flows that you need to set aside. Second pot of cash flows is this minimum cash flow annuity type of thing that I need to have in the future. That's just for immediate family needs. The third is what you save over and above this is really what you want to leave behind as a legacy, or what you want to splurge on. Maybe you set aside some amount of money to make sure your household expenses are met, but then you want to do international holidays, you want to do certain other kind of, my bucket list is that I want to go and take a boat and sail around the world, whatever that is. That cannot be solved by a product which gives you 7% per annum. So you start especially when you have long horizons. So that you need to make sure you have other things in your portfolio that gives you that extra rate of return. So when you look at long-term savings, what I'm trying to say is that have this allocation approach. It's not just about one versus another. Yeah. And so this is just one part of your sort of savings kitty.
Yeah. Another question that we're getting asked quite a bit, Siva, is that when you look at, and this is more to do with markets now. When you look at where we've seen bond yields historically and where we see them today, do you believe that something like what we're seeing today, a flat yield curve, does it make sense for you to time an entry into a long duration fund? Obviously, I'm assuming the investor here has a slightly shorter investment horizon. What's your take on that?
As I said, one key risk of investing in a product like this is that while you're making your investments, the yields decline substantially. And because that is the key determinant of your long-term, whether you look at compounding or whether you look at annuity, whatever it is, one critical risk is during your investment phase, which could be next 5 years, 10 years, or it could be anything else. So how do you manage this becomes very important, but this can work both ways. That if the yields drop while you're making your investments, then obviously your compounded rate of return drops. It's also possible that a one-off risk presents itself, which pushes G-Sec yields above 8 or somewhere in the range of 8 to 9%. It's only happened twice in the last 15 years, which is once when in 2013, when you had, very, very briefly in 2018, when you had 10-year yields above 8%. But you need to go to 2013 during the mini crisis. Well, 2018 was a mini crisis. 2013 was a proper taper tantrum crisis. And then you go back all the way to 2008, when 10-year was at about 9.5%. So this once, maybe in 5 years, 10 years, you may get an opportunity where things really blow up and the yields go to 8%, 9% or more. That might give you that sort of once in a decadal opportunity to just top up a product like this. So look at two things. Look at how, rather than timing the market, look at a base case and how to time. If you time with all your money, then there's a big risk that the market call goes against you. As I said, look at this year itself, for the last 6 months. Despite the fact that the RBI has raised rates by 150 basis points, yields have dropped by 30 basis points. That's just should be blowing everybody's minds, right? that here is RBI raising rates consistently, talking hawkish, talking all the right commentary, and then your market yields which have dropped by more than 30 basis points. So there is the risk that if you wait, and the longer you wait, when you look at over horizons of 5 years, 10 years and more, the more we move from being a developing economy to a developed economy, interest rates, yields in India will converge with the West.
Yeah.
So the longer and longer you wait, there is every possibility that the rates at which you deploy may go the other way. So get started, one, right? Two, even if you're looking to time, have a benchmark in your mind. Let's say if the interest rates, if the yields on 10-year GSEC or 30-year GSEC go above 8% or 8.5%, I'm going to really double up my money or whatever it is. What's your thought process along that line? That's, I think, the second thing to keep in mind. I think if you work with this approach, don't have to think too much about timing risks. And last point, which I think we have already talked about, is that if your horizon is long enough, these mark-to-market volatilities, short-term volatilities don't really matter too much from your savings perspective.
Sure. So let's take a few market questions now, Siva. The first question that I picked out here was about credit funds. Now, obviously, it's all guns blazing on the economy. Credit growth is at multi-year highs and all of that. Where do you see the opportunity in credits in this environment? Do you think there is sufficient reason to go down the curve, take a little more risk in single A's or so?
Yes and no. Of course, if you look at credit risk funds as a category over the last 2 years, I think reasonably the best performing subsegment of bonds. So when you're, especially 2 years ago, during that initial phase of COVID, and because one large fund house shut some schemes, etc., it created significant volatility, and the spread between government securities and AAA was very wide, and the spread between AAA and AA and single A, etc., were also very, very wide. So there was a point of time when valuation was really in your favor. But today, that's no longer the case. Those spreads have normalized. So they have actually, in case of AAA over government securities, you're barely getting any spread at all. So what is happening now is that while the underlying fundamentals of credit have substantially gotten better, corporate credit performance has been fantastic in the last 2 years. And the number of rating upgrades have vastly outpaced the number of downgrades. So which suggests that even credit rating agencies and everybody behind this. But it does also suggest that the best performance is behind you. And looking forward, the spreads which are at multi-year lows really is what keeps me from being a very, very big pull on taking a large amount of credit risk. So it's really a bottom-up thing. You have to fight on a trade-to-trade basis, security-to-security basis to get that spread that you want. So yes, there is some value, but in aggregates, it still looks a little difficult. I'll say here that this is likely to change over the next year or so. As credit growth picks up, and especially as business investments go, as the investment cycle starts, you should start seeing more and more borrowing by corporates in the bond markets. Today, the issuance or borrowing by corporates in the bond markets is still very low. And that's keeping the spread between government securities and corporate bonds very tight. As that more of the borrowing comes, as the investment cycle kicks off, you should start seeing these spreads widen a little bit more. So I'll say, if you're looking to buy credits, you could stay invested. But I would say if you're keeping your powder dry, that also makes sense to me.
Okay. What are the triggers that you just did allude to, corporates not coming to the bond markets? What are the triggers for them to move from, say, bank financing to, say the credit markets?
Yeah. So if you look at banks, this extraordinary credit growth they have, 10-year high in terms of growth in credit, and you break that down, you see where are they seeing the maximum growth. One pocket is retail, mortgages and other retail credit has been very, very strong. Another pocket is SMEs. Now, the interesting thing is retail and SMEs are not corporate bond issuers. So despite the strength in borrowing from banks, there is no spillover or there is no borrowing in the corporate bond market. And the corporates, the larger corporates, the AA and the AAA rated, they are still using their own cash. They're sitting on large amounts of cash. They have very low leverage, and the own funds liquidity is first driving investments. You've seen a lot of FDI which has come through in the last couple of years. So a lot of investments have gone through FDI and other sources. Government has been a big spender in infrastructure. So a lot of capex funding has come from the public sector rather than the private sector. So it really will take, I think, some more time, maybe a couple of quarters more, before we really start seeing that private sector capex pick up in such a way that then they start accessing the bond market. So it's still, I think, from a bond market perspective, still a couple of quarters away.
Okay. Okay. Coming back to the fund, Siva, how did we arrive at this decision of saying 30 years? For example, you've got other products in the market who've got a 40-year, a 50-year, a 60-year type of maturity profile. So
sorry,
why?
Shane, just to
Yeah.
there
So
is
why
nothing
did
longer
this?
than this. So the longest
Yeah.
duration security is available. Government of India security is 40 years. So you can't really go
Okay.
much longer than that, right? So the
Okay.
most popular segments in the mutual fund industry are much shorter than this. The longest probably goes to about 20 odd years. And so in the MF industry, it's much shorter. Of course, there are alternate products, non-mutual fund annuity kind of instruments, where, of course, you potentially have whole life kind of. So there, of course, you have a much greater annuity type of structures, where in some sense, the market risk or the risk is being taken by that entity rather than you being exposed to market risk. Of course, consequently, the yields typically are lower than the market yield, because someone is that guaranteed rate of return comes at certain risk for which that entity needs to be compensated. If we take our market risk ourselves, of course, we get the market rate of return as well.
Yeah.
So in that sense, one of the things that was very important to us, I think, has been this idea of making a really long duration product. I don't think we have long duration enough in the industry. So I think we want this to be really perhaps the longest duration product that's available to investors.
Yeah. Okay. Shifting gears again, sorry, to the market. If you were to look at what the RBI has been doing over the last couple of policies, where do you think is the peak at this point? Where do you think is an environment wherein we will start to see the RBI stop raising rates?
I think the RBI is
cutting rates. Yeah,
I know. You're a bull, right? You can all start thinking of rate cuts, right? We all want that. So I think rate cuts are quite some time away. I think central banks around the world have been burnt by this inflation.
Yeah.
You look at it from RBI's perspective. The RBI's official target for inflation is 4% per annum.
Yeah.
They like to talk about a range of 4% plus or minus 2, but there is no such range which has been given to them by the law. The RBI Act and the rules there to specify a single target. Your target is 4% per annum inflation.
Right.
The actual inflation over the last 3 years has averaged 6%. So, okay, 1 year you're at 6%. It happens. COVID happened. Some one-offs happened. Second year you're still averaging close to 6%. We all have to ask ourselves, okay, there's a few raised eyebrows. 3 years you're averaging 6%. Your target is not 4 anymore. A significant part of the reason why yields have risen so strongly over the last year or so is this reset of inflation expectations. Let me just put this in a slightly different way. In financial year 21-22, that's previous financial year, not the current one, yields rose by 100 basis points. In 21-22, the RBI did not raise rates. They held rates. Rates were held constant at 3.35%. There was no change in interest rates. In fact, the RBI purchased large amounts of government securities in open market operations. 2 lakh crores of what they call GSAP 1 and GSAP 2. Over and above that, the fiscal position of the government got a lot better thanks to inflation, etc. We saw record tax collections, GST collections. So the government ended up with a much stronger fiscal position. So one would think no rate hikes, better than expected fiscal position, and RBI coming and doing OMO support of the markets, why did yields go up by 100 basis points? Logically, that made no sense, except if you look at it from this angle, that yields rose because markets are forward looking, and then they saw that, okay, listen, all of the things that you do in terms of pumping money into an economy, OMO or GSAP is nothing but monetization of deficit in a different way. All this addition of liquidity into the system is adding to inflation, and this sort of all of our minds, we kind of started thinking that inflation is not going to be anchored close to 4, but inflation is now moving closer to between 5 and 6%. And that reason why you've seen a significant rise in yields. But it doesn't mean that this will continue to happen. That's something to keep in mind also. That yes, inflation expectations have shifted up from 4-5 range to 5-6 range. Mm-hmm. But it is very unlikely that they'll go above 6, because by mandate, they have at least, there's an upper threshold of 6. Even though there is no law saying that you have to target 6, but at least there's an upper threshold of 6, and RBI seems to be sensitive for bringing inflation down below 6. So even if long-term inflation remains, let's say, closer to 5 or between 5 and 6, today's market yields on 10-year G-Secs of 7 quarter 730 or 30 or 40-year G-Secs, which are at, let's say, 740 or close to that, are reasonably above what we can expect long-term inflation or medium-term inflation to look like. So I think we have seen a significant shift over the last year or two in terms of markets thinking about inflation, and that's kind of been behind this rise in yields. But I don't think it's going to keep on going. I think I had a long-winded answer to your relatively simple question.
Yeah.
I hope it helps people.
Yeah. So I think there is a lot to digest in the next year as well, with the budget coming up, the elections coming up. So I'll end this with one final question. So where do you see the 10-year in the next year? Where would you hope to see it?
See, there's a saying in the markets that you don't give a forecast, right? And if you give a forecast, don't give a time frame with that. So you're asking me both the questions. Where do you see the yields and over a 1-year horizon? This is exactly the kind of thing which I, as a professional investor, should not be making a forecast. And I think while it's very tempting, and everybody will have these end of year notes which say that our view is for next year that the 10-year G-Sec will be 7.35%, or even add more decimal points. Nobody knows. What we believe is that we are reaching the end of the rate hike cycle. Maybe one more hike, 6.5%, RBI stops. All that is broadly priced in, right? Yeah. Unless we get something which is an extraordinary shock, right? So, for example, if the US rates go well above 5%, maybe 5.5 or 6% or something like that. I mean, it's today unimaginable, but unimaginable things have happened in the last year, so we can't rule it out for next year. So if global interest rates rise well above expectation, or if, as we saw in the last year, the rupee dollar exchange rate substantially shifts and we see further bout of depreciation, or indeed, as you pointed out, if the budget ends up being a very populist budget ahead of election. So there are multiple things that can cause a big shift in thought process. Now, these shifts can happen in both sides. If the government decides to go for a fiscal consolidation, yields could drop materially next year. Right?
That's highly unlikely, given that elections are around the corner, right?
See, we must keep in mind that the Indian electorate dislikes inflation.
Right.
So, if the government is really serious about it, in the trade-off between growth and inflation, growth is taking care of itself right now. Yeah. Undercurrents are very strong for India. We are seeing many indicators. In fact, most indicators go above the pre-COVID levels, right? Yeah. Credit growth is back. So many growth indicators are back. The need for the hour is to anchor inflation expectations so that inflation doesn't run away. Right. So if the policymakers are really smart about it right now, the focus should really be to ensure that the outcome for economy is continue the strong growth momentum, but nip the inflation story. Yeah. So the inflation, this is the reason. This is, I think, something that we need to keep in mind, and this is therefore it's not obvious to me that all the risks are only biased towards upside. I think where we are today and is kind of a sort of an inflection point. My assumption is next year will be more of the same as we are seeing in the last few months, which is relative stability.
Yeah.
But I would not be surprised if we have, more one-offs which can cause some kind of disruption. We should welcome a state of relative stability because the last 2 years, thanks to the pandemic, has been extremely volatile. And we would want some kind of relative macroeconomic stability. So I hope that's what pans out.
Sure. Sure. So you hope for stability at the end of the day. So that's that, and in that scenario, I think the long duration fund would work very, very well for investors. With that, thank you everyone for joining us this evening. And we will continue to keep hosting events like this so that we hear from the experts about various events around the world, as well as how to position your portfolios. Thank you, Siva. It's been great. It's been really, really educational. And we hope to have you on soon. Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.